edition of Market Takes. We are breaking down the latest U.S. existing home sales report, and we're using that to talk about the big picture in the U.S. housing market. I got people calling me, Dion, what's going on in the housing market? Is it a good time to buy a house? We're going to break that all down right here. I am Dion Rabouin, reporter for the Wall Street Journal, and we are going to dig deep into today's U.S. existing home sales report. There was a lot of really interesting information. It's going to tell us a lot about the economy, what's been happening so far, and maybe how investors are viewing that information to make moves in the market. We're seeing a lot of moves today. So we are going to talk through today what the existing home sales report showed. We're going to, of course, talk about the overall state of housing, how the state of housing is playing into expectations or worries about inflation, as well as how the housing market is playing into expectations and worries and fears about a recession. Of course, we're going to check out the markets, talk through stocks, bonds, crypto, FX, commodities, all that good stuff. And then we're going to tell you, of course, what to look out for next, because even though it's backward-looking data, we are always looking forward here on Market Takes. So without further ado, let us jump into the data. Now, today's existing home sales report showed that prices fell unexpectedly. We have seen here a real consistent decline. We've seen 12 straight months of declining overall sales. And we saw the pace of sales fall to 4 million sales. That's down 0.7% from the previous month, but 37% year over year. So sales are slowing by 37% from where they were in January 2022. And again, that's the lowest rate of sales since October 2010. So got that chart up there just to kind of illustrate where we have been on existing home sales. You see that just precipitous decline in terms of the number of homes sold. That's not exactly what's happening with the price though. So if you're looking for big price declines, the news not quite as good as if you're just kind of betting against the overall housing market. Now, expectations coming in, economists had predicted there would be 4.07 million houses sold and a 1.5% increase. So economists were predicting that we would reverse the overall decline that we had seen for 11 straight months, and that existing home sales would creep up this month just by a little bit, by 1.5%. We did not see this again. Instead, saw a 12th straight month of declines in terms of the number of homes sold. That is the longest stretch since 1999. So existing home sales, really the number of homes just consistently turning down and turning lower. Now, when we talk about price though, on the other hand, the median price of a used home in January was $359,000. That's down from $366,500, just a little bit, about 2% decline, but year over year, the median price did pick up by 1.3%. So I want to put another chart up here on your screen to just illustrate what we've been seeing with prices. This is the percent change from a year before. So as we see, as we're at the beginning of your screen there on the left side, you see prices are increasing by about 15, 16, around that 15 to 20% range. And you just see that pace decline, decline, decline until we get to January of this year, when we saw just a 1.3% increase. So again, prices are still increasing. You're still seeing overall existing home sales prices compared to a year before continuing to rise, but that pace is decreasing and declining. And we see up here with this chart the illustration of how that price growth has been declining consistently. That's not the overall price, that's just the increase in the price declining from those big increases that we saw 15, 16, 17% early on in last year, down to about 1.3% to start this year. So that's, I think, something to watch for, as we could see outright year over year decline, something we have not seen in the existing home sales report for a very long time. Let's get into some details, because I know y'all come here to nerd out with me. We're going to nerd just a little bit. We're not going to go too far, but I do want to get into some of the details in the report. One really interesting thing that I saw, this was expected. The days on the market increased to 33. So we are now at a point where the average existing home is on the market for more than a month. That's big, because we were a year ago averaging 19 days. Now that was historically low, a historically low number of rates. Now we're getting back into where if you list your home and go to sell it, it's gonna be on the month for about a month or over a month average. That's almost double the pace that we saw in January 2022. Inventory, as in the number of houses on the market, is still holding firm. That's at about 3 months, 2.9 months, but that is declining from an increase in inventory that we saw in 2022. So what I mean by that is the inventory is just the number of homes available for sale. During 2020 and 2021, you saw that inventory just crash and burn as fewer people were listing their homes, and and the homes that were on the market were just getting snapped up really quickly. So there was a lot less supply of homes in the market, and there was a lot of demand. Well, in 2022, you saw supply kind of start to decrease and demand really start to increase, which was kind of expected to even out those prices. But what we are seeing now, demand is holding steady. You're still seeing high demand, but the supply is starting to level off as people are saying, oh, well, now's not a good time to sell. Builders are saying now's not a good time to build, and you're seeing a leveling off and a potentially decline of the inventory of home sales on the market. This is just existing home sales, so not new home sales, but basically the number of people listing their home for sale is leveling off at about 3 months worth of inventory. So another very interesting piece of data I found in this report was cash sales have increased to 29%. That means almost, not quite, but almost 1 out of every 3 homes sold has been sold in cash. That makes sense when you're talking about a market where interest rates have increased, mortgage rates are increased, the overall price of getting a mortgage has increased, even though prices have stopped increasing at the same rate or at this very fast rate they were. But the overall price to buy if you're a mortgager has increased, but if you're a cash buyer, well, now is actually a great time because you're not having to come in and fight over price. You're not getting, 10, 15, 20 buyers trying to get that house on the first day. And if you've got cash, well, you're probably paying a lower price than you would have paid a year ago versus someone who's getting a mortgage. Now, those cash buyers, that's increased to 29% of sales from 27% the month before. We're also looking at another interesting stat. The percentage of first-time home buyers rose to 31% of sales from 27%. As these rates have climbed up, folks at the National Association of Realtors have worried about existing or first-time buyers being priced out of the market. A lot of those people on the lower end of the income spectrum have been priced out, but we're seeing now an increase, and that increased in December as well, and you saw another increase in January to 31%, almost a third of the sales coming from first-time home buyers. That's big, and this number of sales to investors in those big companies, you hear about KKR, you hear about Blackstone, all these companies coming in and buying sales, well, that number decreased to 16% from 22% a year before. So we're seeing more first-time home buyers, more folks buying in cash. That usually means wealthy folks, people, high net worth investors, those kinds of people. They're buying a lot, but also first-time home buyers, people who haven't owned a home before. Now, this is good in the sense that more people are buying houses rather than corporations. We know when corporations buy, they like to jack those prices up when they rent it out to folks, and that kind of saturates and moves the rental price up. So we're seeing things that could suggest rent prices could be decreasing. But one thing, if you're a market watcher and you've been watching the market for a while, one thing you know is that we're seeing retail investors move in. What investors, professional money managers call the dumb money is starting to get into the real estate market. And that's generally a sign that the market might be peaking out and it's time for smart investors, the smart money, as they say, to get out because the dumb money is moving in. They usually buy at the top and sell at the bottom. Historically speaking, we've seen some difference and change in that over on the stock market as more folks are getting educated. But these numbers do suggest that we're seeing big time investors move away, worried about some fears that the market might be overheating, that these increases by the Federal Reserve are going to crash the housing market, while we are seeing regular retail investors, so-called dumb money, moving into the market and buying. That's generally not a good sign if you're talking about asset prices. So let's take a step back now and talk about the overall state of the housing market. We have seen declines really across the board. I want to read a quick quote to you from Jeffries, a note they put out today. They say, quote, "The details of the report suggest that housing is no longer a seller's market. Until this summer, home prices continued to rise despite declining demand, likely because supply was so muted. However, the balance of power is finally shifting from sellers to buyers, albeit slowly." That slowly part is a big thing because we could see this balance of power actually shift back because, as I told you, supply has really kind of petered out and kind of plateaued. Existing home sales is the largest. It's about 85 to 90% of the overall housing market. So this report is the one to watch. Now, prior to this, we saw housing starts slow by 4.5%. That was double what was expected and down for the 5th month in a row. We also saw single family home building decline 27% on a year-over-year basis in January. We're seeing mortgage applications decline. Basically, a lot of these things that could have been getting better have actually been getting worse on the housing market. And like we talked about, about, those interesting details that show it's much more retail investors, mom and pops, maybe just regular folks buying homes. A lot of them buying with cash though, so probably not, mom and pop Aunt Becky down the street. It's probably Aunt Becky with the big bag buying a house right now in straight cash. This also plays into the big picture, which is that housing is slowing down, prices starting to move lower, but still increasing. That's a trend to watch for, because overall in 2022, you saw that big decline in housing. We need to see that continue for prices to really meaningfully move lower when mortgage rates are starting to pick back up. And we'll talk about what we're seeing in the markets and how that relates to the mortgage market in just a second. So the role of housing in overall inflation is we're looking out at overall inflation and how housing plays a role in that. I want to throw up a chart of CPI, the Consumer Price Index here, to just kind of illustrate what we are seeing overall in the market. So inflation, we're going back about a year now. You see that consistent pickup until that peak in June, and then prices have come down consistently each month. Now, as that has happened, we are seeing inflation come from that 9% level where it was in June down to 6.4%, which is where it was in January of this year. Now, in June of last year, that 9% was the highest we'd seen in around 40 years. It peaked up there and it's been coming down, but the pace has not been as fast as a lot of folks would expect. So as you see, those numbers still very high when you compare it to historical long-term averages, when just 5 years ago, the US couldn't get to even 2% inflation. The Fed was worried that we might have disinflation and that they needed to do a lot more to stimulate the economy. So this CPI chart kind of illustrates that overall theme that we had seen with the pace of overall inflation. Listen, approximately 9 out of 10 metro markets registered price gains in the fourth quarter of 2022. That means prices are not going down. They're not declining. We're not seeing disinflation in the housing market. That was according to the National Association of Realtors' latest quarterly report. I want to read you a quick quote from NAR Chief Economist Lawrence Yun. He says, "A slowdown in home prices is underway and welcomed, particularly as the typical home price has risen 42% in the past 3 years." That is big. Now, he's saying these increases have far surpassed wage increases and consumer price inflation since 2019. We are seeing a decline of the pace of housing price increases, but prices still going up even as the number of homes sold is low. That's not good if you're trying to sell your house. It's not great if you're trying to buy a house either, if we're being honest. We have seen lower rents and some decline in the housing asking prices overall, but not big declines. We're not seeing the housing market crash except in terms of the number of sales. So let's talk about housing in terms of the role of recession fears and some of those worries that folks have had about a US recession. This report certainly does nothing to alleviate any of those fears. If the housing market is crashing, that does a lot of damage to the rest of the overall economy. We're seeing housing, listen, mortgages are a big piece of the overall borrowing market, and we have seen a huge increase in borrowing. But one thing that housing does do is it provides a place for folks to borrow cheaply. So if you want to get a home equity loan or home equity line of credit, or you want to pull money from your house in one of those ways, that's a much cheaper way to borrow money than if you have to get a personal loan, if you have to go out and get a property, a title loan, something like that, or borrow from your credit card. Well, we are seeing those housing prices, as those decline, as folks are less excited about giving big loans out for folks borrowing against their mortgage, that means folks are going to have to turn to other sources of borrowing, because we've seen those savings buffers are getting just wiped out. The personal savings rate for Americans right now is down around 3%, even lower, some of the lowest levels of consumer saving that we have seen in decades right now. And so folks, those saving buffers that they built up during the recession, the pandemic, those have been really wiped out, and people are kind of on their last legs and they're starting to borrow a lot of money. Consumer credit rose by $33 billion in November and $11.6 billion in December. Those are big numbers. And so home equity lending and mortgage borrowing is a big piece of those overall borrowing numbers, but we are seeing a lot of consumers turn towards credit cards and borrowing on their credit card, whether that's taking a loan or just putting things on their credit card they can't afford to buy right now. Personal loans, title loans, all those have picked up, and we are seeing an increase in delinquencies. We're seeing folks fall behind and being unable to make their payment. That's adding to some of these recession fears and recession worries, because folks are not really able to, if your house had risen $100,000 in value last year, well, now that increase is only only $50,000 because the value of your home is falling because prices aren't increasing as fast. And so people aren't able to borrow. Maybe they say, okay, well, I can only borrow. And remember, you can only borrow a percentage of the equity that you've got, and you're having to borrow at higher rates now. That's a lot less attractive for some people, and they're having to turn to some of these other methods, or they are turning to some of these other methods for borrowing that cost a lot more to be paid back. This also hits into housing companies, home furnishings, things like places like Target, Walmart. We saw just this morning Home Depot guiding lower in its earnings call, and their stock taking a big hit, was down 5% early on in the market today. And as they forecast an earnings decline, that also hit companies like Lowe's. Housing plays a big part in the overall economy because when people buy a new house, they don't just buy the house, they buy stuff to put in the house, they buy some paintings, they invite their friends over, they have parties, all those things. If those things aren't happening because people aren't buying houses, as we've seen with the overall pace of housing purchases, well, that puts a dent and some worry in the overall economy. That can pick up these recession fears, and that might be why we're seeing what we're seeing in the stock market. So as we look out at the overall market right now, we are seeing the stock market down in a big way. The S&P 500 is down about 1.6%, and the Dow, the NASDAQ down about 2%. We are seeing bond yields up in a major way. We're seeing the 10-year note up about 10 basis points, up to about almost 4%. It's about 3.92% right now on the 10-year yield. The currencies, you're seeing the dollar rise. It's up against the euro by about 0.25%, up across the board, except against the British pound. Watch the British pound. If you're in the currency markets, that's definitely the one to watch in the coming days. We're seeing crypto down by about 2 to 3% across the board. Bitcoin down about 1.4%. Commodities, one interesting thing to note, we are seeing natural gas just nosediving. It's down at a low. This is the lowest natural gas has been in quite some time. Going back on WSJ.com, we're seeing nat gas down the lowest in more than a year. It's heading towards that $2 mark, and that is a huge, huge area of resistance. You're going to want to watch nat gas at that $2 mark. Copper, though, up in a big way. Copper, aka Dr. Copper, a well-known indicator of the U.S. economy, up about 2.6% today. Has been rising for quite some time. Definitely watch copper. So listen, what comes next? Here's what we're looking at. The FOMC minutes, the minute from the latest Fed meeting, come out tomorrow. We will be watching those very carefully because investors are very curious what the Fed thinks about all this new data. The new home sales report is out on Friday, as well as the University of Michigan Consumer Sentiment Index. We have seen big increases in that report lately. We'll see if that continues, if consumers continue to feel good as gas prices keep falling. And on March 1st, that's a couple weeks from now, or sorry, a week from now, don't worry, we're coming back here on Market Takes. We will be talking about the global manufacturing PMI, talking about the state of the global economy, businesses, and how they are doing overall globally. We will be breaking all that down right here on Market Takes on March 1st. Listen, I know you can be anywhere in the world. You were here with me today. I hope you'll be with me again on March 1st when we do it right here on Market Takes. Listen, that's going to do it for today's edition of Market Takes. I am Dion Rabouin, reporter at the Wall Street Journal. I hope you'll be with us next time.